We're proud to have this episode sponsored by Shakepay, the easiest way for Canadians to buy and earn Bitcoin. I love using Shakepay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the Shakepay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, Shakepay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on Shakepay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for Shakepay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, Shakepay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 58. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management in his sexy black shirt, and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen.
Hello.
Rich, what's shaking?
Not much. I'm working on improving my home. Last week you made fun of me for not having any furniture, so I went out and bought a desk. But I was interrupted from building it because of you guys. So that's all that's going on. I mean, there's lots of good stuff going on in the market, but I'm sure we'll get into that.
Any good sales there? All these stores are overloaded with inventory.
For sure. You're starting to see it all kinds. There's lots of good sales. The clothing stuff, furniture is definitely getting marked down. I mean, listen, people spent a lot of money the last 2 years buying crap they don't need. So it's about time we get a little discount here and there.
You're telling me I got a Peloton bike to sell if anyone wants it. Keith, what's going on?
Well, I'm sort of reminiscing about the days of the shutdowns when it was socially acceptable to cut your own hair. I'm at that point now. So we'll see this week. Do I do it myself or do I go? I need a haircut.
You should get one of those bowl cuts for the event coming up here in 2 weeks.
I already have a bowl cut. This is it's growing out of it.
Maybe that can be actually part of the event is we'll do a Keith Dicker live haircut on stage.
Down in Bermuda for we used to call it St. Baldrick's Day. So for St. Patrick's Day, at one of the pubs down there, it was a big fundraiser. So you'd line up and get your head completely shaved off, everyone throwing money into the hat for it. But those were good times as well. At the Robin Hood, if you know Bermuda, it was at the Robin Hood pub. You know what I'm talking about.
Never been.
There she was.
We aren't all well-traveled like you. But let's dive into this week's show. We'll kind of open it all up with the Canadian side of things, as always. Fair amount to talk about. I think we'll get into it, but obviously the FTX crypto story continues to evolve. I think the facts there are mind-boggling, so we'll kind of get into that, some inflation numbers, etc. But yeah, I think we'll start this one off here with the Canadian real estate data. Looking at it from a national basis, so for those keeping score at home, every 15th of every month, you get the release of the national housing statistics. So it was always kind of a good barometer, but we were looking at it. So national house prices fell another 1.2% month over month in October. So your home price index, which adjusts for sort of volatility and hedonically adjusts for property types, that home price index is down 15% since peaking earlier this year. So that's the sharpest decline since index was created in 2005. I feel like I keep saying that every month now because we keep setting sort of a new record drop. Again, just for context, the last peak to trough decline that we saw was 9%, and that was in 08-09. National house price declined 9%. So as of right now, we are down 15% from the peak. That equates to $132,900 since peaking in March. So that's what your typical home in Canada has lost. Yeah, I mean, other than that, it's kind of status quo. I mean, the market's still slow. Rates are still punitively high. The one thing to sort of put into context here is there was just 3.8 months of inventory on a national basis. So it's still pretty low. Your long-term average is usually around 5. So we're still looking at low inventory levels, but despite that, house prices have been trekking lower. So that's pretty much all I got on the national housing front.
Steve, what about condo inventories? What are they looking like?
Good question.
Same thing. It's all across. I mean, I think like what happens is, at least in Vancouver and Toronto anyways, is that the markets are actually somewhat predictable, which is, the detached housing market, single family always tends to lead the market. So it'll lead the market on the way up, and then the condos always are lagging behind. And so right now we've seen the bulk of the corrections are actually happening in detached housing product. And I think the condo market is probably going to see more of a correction in 2023. So if you got a condo, thinking about buying, selling, whatever, I think there's more downside in the condo market than there is in the detached segment in the new year.
And wouldn't that be the market where,
Where
where people levered up, where they would have bought one or two, like for investment properties as opposed to a home?
Yeah, for sure. I mean, you typically see most investors because you can't cash flow. Like, people it's funny, right? Because I get a lot of commentary online and stuff. They go, "Oh, these damn investors, they're ruining the housing market." So, well, no investor buys a single family house for $1.8 million and renting it out for $5,000. The numbers don't work. What investors tend to do is they tend to buy condos. They might lever up their house, tap some equity, and then go and buy a single family or one bedroom condo, pre-sale condo. So that is where most of your investors are playing.
And rental yields?
You want the cap rate kind of thing?
No, I'm just curious about are the rents continuing to go up? We're going to talk about inflation in a minute, and there's some rental data in there, but I'm just curious, sort of from your perspective, are rents going up?
Everywhere I look, everyone I talk to, rents have peaked. I would not necessarily say that they're going down, but they've clearly set a peak in basically every major market: Toronto, Vancouver, Calgary, the 3 markets that I pay close attention to. They've all peaked. So I don't know. I'm sure we'll get into the CPI data that will probably show up in 6 months from now.
It's actually already peaked, and we're going to get to that in a second. But just a little digression. The CPI rental, the index that tracks rent in the CPI basket, is actually already peaked as well.
Oh, it has already.
Yeah. So we'll see. Anyway, sorry, keep going.
A couple other things, I guess. Just it was an interesting announcement. You were starting to see, I think we chatted about it last week, right? You're starting to see these anecdotal things that are adding up to stress in the housing market, right? So we had last week we chatted about Romspin, which is the $3 billion mortgage investment corp in Canada, gating funds, one of the largest mix in the country. This week we had big layoffs announced at Properly. So Properly was a Canadian real estate startup. They were trying to disrupt the traditional brokerage model. So here's what they would do. Pretty interesting model. I actually chatted with them. Really nice people. So it's always sort of sad to, see people getting laid off. And like I said, I think the company is well intentioned, but I remember chatting with them and I was like, this is not going to work. This is predicated on a bull market. Again, hey, maybe they figure it out. Kudos to them. But basically what they would do is so let's say you own a home and you want to go and upsize. So what you typically need to do, right, is you need to go sell your house first, figure out what you're working with, use that cash, go buy a new house. But there's always this awkward sort of middle part where you're probably you're almost having to go and rent for several months while you make a transition to a new home, because getting the completion and possession dates to line up perfectly is really, really hard to do. And so what Properly was doing, and so this is where people got really caught offside, right? The market in Vancouver, Toronto, most of Canada was so hot. It was so hard to buy a home because every home had 8, 9, 10 offers on it, right? So imagine if you had like sold your home already. I had clients where it took them like 6 or 7, 8 months to get a house because they would lose out on 5 properties before they finally secured an offer and a bid on a house. So what Properly was doing was they were saying, listen, you go out, you've got a home, you go and buy first. Go buy your home first. Properly will give you a bid on your house. So they'll say, we will give you a contract that says we'll buy your house for $1 million. And then you can use that to go to the bank and say, hey, listen, I've already sold my house. Here's an offer from Properly. And so basically what Properly was doing is that they were selling it for like a couple percent or whatever, a little bit below market value. And so the idea was that Properly would then go and try to sell your house. And if they got you a higher price, that was great. Everybody gets paid, they move on. But Properly would then, but if they couldn't get you a bid, they Properly would basically go ahead and purchase your house. And so the concern now is, well, you're in a down market. Are these guys stuck with a bunch of houses? I would.
So they were selling the wrong side of that optionality, basically.
Right, because the market turned. I mean, it was a great business strategy
in a bull market.
In a bull market, but like we all knew the bull market was going to end at some point. Anyway, so the long story short, those guys were kind of like heralded as kind of the new up and coming thing in Canada. So yeah, that's in tough spot right now.
Hey, Rich, don't you love linear thinking?
Like I said, I'm
a lateral thinker, Keith. Lateral.
Me as well. Yeah, me too.
I'm not trying to trash these guys. Like I said, I met them. I think they're nice people. The business strategy to me is just it. It is.
Well, this sort of ties into something I wanted to bring into this. Rich, sit down for a few minutes, Rich. We talked before about, now we're set up to have these, pretty massive booms and bust and a lot of different things. And in my complaint about the world is back in 08, 09 when everything went bust. Is not popular to say this, but that they should have let banks go under who should have went under and stuff like that. A lot of people say, no, they would have done this and that. But, I saw because my thinking and my belief is that there's always capital out there, private sector capital that's enough, is absolutely going to take an opportunity, take the risk. They deserve their return and they deserve the loss as well if it happens. But, the world today, they've created this environment where you get all this linear thinking. You think either there is no risk. And even if you do think there's risk, you're thinking behind you, and maybe not for these guys because they're not big enough, Steve, but, someone's going to bail them out. But I saw an interesting article this morning. So there's 7, it's just covering 7 institutional investors around the world, and they have about 2.3 trillion in capital. They're ready to employ or deploy. And so think about it. There's these guys out there. They've raised the capital. They're sitting on it. They know something's going to splat against the wall coming up, and it's not a bad thing. It's bad if you get splat, of course. But that's the way capitalism works. You have a P and L, profit and loss behind it. And I do happen to think we're going to get a few more splatters coming up soon. But there are people out there who are willing to then invest their own equity to get things going again. However, what I expect will happen if it is, one of these systemically important institutions with, political friends and brackets coded behind it, they will get bailed out. And that's why we all pay for it in the end. But think about it, 2.3 trillion is just waiting to come in. And and these guys are smart guys, right? So they know there's something coming.
It's the ice cap fund.
About. It's we don't have 2.3 trillion. But I think what I wanted to talk about as well, unless Rich, you want to jump into that, but I want to go into the anecdotal stories about, this recession that's apparently coming. And then we have the headline data. And a lot of that, especially for Canada, it's not suggesting, the recession is coming. So, we have some contradictions taking place.
That's a really good point, because I feel like the anecdotes don't quite, like the data doesn't square with the anecdotes. And what's that quote from like Jeff Bezos? It's like, if the anecdotes trump the data, like the anecdotes are probably right.
Well, wait a second. I mean, we still have to
Something
talk about how
like-
inflation release. But
Oh,
the
yeah.
data,
Whoa, I'm
we
not
talked
done.
about it
I'm not
last
done
week.
either.
The Canadian data, we're all getting ahead of ourselves. The Canadian data was deteriorating as we went over last week. Remember? I rattled off a bunch of stuff that was really not so good. So I'm interested in hearing some of these anecdotes and to see if they square with that. But all right, over to you, Steve.
Well, yeah, I'll wrap up my Canadian housing topic. I'm sick of this plus stuff here. But yeah, these, we're seeing a lot more now of the lenders. The lenders are now laying off mortgage staff, which is interesting because what's crazy is there was a lot of local credit unions and whatnot here. I remember in Vancouver, they were adding mortgage staff in like April and May. The market had so obviously peaked in February and was beginning to roll over, and they were still adding bodies in April and May. So they were obviously, not very insightful, I suppose. But anyways, we're now finally starting to see that there's just not enough volume to go around for all these bodies that they've been adding over the last couple of years. And so we're starting to see layoffs in that space. So yeah, I think the anecdotes are just continuing to sort of add up with, again, Robinson, the private lender, some of these tech style real estate brokerage startups. And then you're seeing the mortgage layoffs and obviously the construction pausing and stuff. So anyways, it's all adding up, and then you take that and you look at the home price index nationally down 15%, and it makes sense. So that's all I got. Rich, I don't know if you want to jump in on the inflation data, because that's going to impact where this rate hike trajectory is going.
Yeah, sure. I mean, I'll just run it down as we normally do. I'll do it quickly because I think not much really has changed. Headline fell ever so slightly. I think sometimes when we see these headlines, it came in as expected, 6.9. Sorry. I screwed that up. Sorry. Start over. Headline inflation rose ever so slightly from 6.86 to 6.88. When we see the headlines, they often only do it to one decimal point. But as you can see on the press release, and as I wrote in my note today, if you just dig a little deeper, you can see actually the number actually rose slightly. This ends a 3-month consecutive decline. So, I mean, obviously I'm splitting hairs, but just, to get, gotta get the numbers right. Core, which is excluding items, just food and energy, that rose. It fell again. Damn it, I'm screwing up today. Apologies. So it fell tiny bit again to its 5.28. And so from 5.28 to 5.27, I'm making a meal of this. Let's bring it home. And but the thing is, I like to look at the components, as we've discussed many times here before. There's goods, there's services. If you look at goods inflation, that rose. Services, which is meant to be sticky and usually related to labor market, that's kind of rolling over. So that was 8.4 for goods and 5.4 for services. I won't read all the numbers, but there's a couple other points that I thought were interesting, which was the shelter component. We've talked a lot about this. The shelter component rose again. So that rose up to 7, and it's 40% of the core CPI basket. And so it's again contributing a significant weight. And so this idea again that we're going to pop right back down. I just for the 50th time on this podcast and in my writings and all my meetings with my clients, no, it's not transitory. It never was. The big contributors, I think, were energy and transportation. You'll notice, if you're not familiar with this, but the crack spreads, we've discussed this before, which is sort of the margin that refiners get from crude oil and gasoline and other diesel and distillates. That started to rise again, despite Joe Biden's best efforts and using the special strategic petroleum reserve to keep prices down. Right before the November election, I'm laughing because it was just such a cynical kind of political ploy to keep gasoline prices and diesel prices down right before a major election. You're starting to see the crack spreads sort of blow out again, even though crude prices are down on the last 3 months. And so that in Canada, that impacted a lot. It was up 6.7% month on month, which is a significant amount. Energy is a non-trivial amount of the CPI basket. I think it's like a 10 or 11%. But again, it's really the shelter component. Food, again, is just keeps rising. These are like the takeaway fast food from stores, table service restaurants. All these are like 6, 7, 8, 9, 10%, which is just incredible. And then finally, the one I always love to talk about is the 3 preferred measures of inflation, which is the ones that capture for persistent price movements that eliminate transitory stuff and sector fluctuations and that kind of thing. It was the exact measures that the Bank of Canada ignored when they were telling everybody that that inflation was transitory, and those ticked up higher, which to me is really the major takeaway from this month's release, that the key the key measures that eliminate those transitory effects or the supply specific fluctuations, those rose after falling a couple months, and those are at like 5 and 5.5 and 6.25%. And it just tells you that, it actually reiterates the point that Keith's made many times, that they should have raised by 75 basis points. They should have not have chickened out. There's still a significant amount of inflation. That's sort of this inflation breadth that we've talked about in the past. It's still happening. And overall, we'll see what happens next. Do I think inflation has peaked? Yeah. Do I think we'll retest those high? No, I don't think so. We've talked about why. There's math element, there's the energy component, etc. But the fact that we're going to head back down to 2% anytime soon, I think it'll probably take at least another year or maybe even 2. So there's the inflation release that we've got.
Boom. Do we have crack spreads on our bingo card, by the way? Is that on there? There will be.
You're so mean. The crack spread's an important part of the energy market. If you don't understand crack spreads, you don't understand energy.
I understand crack spreads. Keith, what are your thoughts?
Oh dear.
Keith yucking it up over there.
Yeah, Keith is just, hanging out. Let's see. So, we had that's the Canadian data, and maybe Rich can go through the American data as well afterwards with the PPI data that came out. But so, from, our view, what's happening right now is that for the Canadian data, it's still high, right? However, the expectation over the last number of months was always that the numbers were going to be higher than what was expected. So this is how we view it, from a market perspective, is, they're no longer outperforming. It's sort of in line with what's been expected. So, Canadian dollar sold off a little bit on the news. It didn't, every other time it's been ramping up aggressively. And now for the first time since we've been on this interest rate journey, not Aerosmith journey, we have interest rate expectations. They're all over the map here. So right now we're at 3.75, 3.75, and so right now, like out to say June of next year, they're expecting another 75 basis points in total. But it could be 3.25s, it could be a 50. Like the market doesn't really know what to expect right now. And the reason it doesn't know what to expect is because the Bank of Canada has been, knocking everyone in the head the last couple of meetings, and that, but the market thought it was 1% priced in last time. They didn't do it. They did that before at the beginning of this. But so the next Bank of Canada meeting is on December the 7th, and that's a live meeting. So right now the market is expecting definitely 25, maybe they do 50. That's what the markets are suggesting. And I know when we get closer to that day, it's going to be, the market's not expecting 50. Like the number's going to be all over the map. So on that day, Canadian dollar is going to go crazy with whatever number comes out. The bond market will go a bit funny and wacky as well. But right now, the market is saying we have no clue what the Bank of Canada is going to do on that side.
It seems like, correct me if I'm wrong, but kind of following Keith, you've been posting some of it on Twitter there. To me, it seems the Canadian data, like economic data, is holding up a lot better than we would have anticipated. And I wonder how much of that, because like, we're overlaying again with our anecdotal stories, that how much of that data is maybe lagging or about to come to fruition, or maybe the economy really is holding up better than anyone could have imagined, and that really paves the way for a higher terminal rate. I have my own opinions, but they're just my opinions. I'm kind of curious your thoughts.
So my thoughts are that the Bank of Canada, they see the same thing. They don't like it, because the only way they're going to get inflation down is to literally crush the economy. Like we need a good negative sign, in front of the economic data coming out, or sub 50 if you live in richest diffusion world. And but right now, though, it is like you say, see, like there's just anecdotal stories coming out. I mean, it's not bad. I was just it's kind of funny because I was chatting with two friends yesterday. One is on the labor market side in the legal world, and this person was telling me, yeah, like there's no visibility of this recession that's supposedly coming. And everyone in my world, we're all talking about it. And same in their world, that everyone's waiting for this shoe to drop. And, people are still wearing their shoes right now. Then I bumped into another guy yesterday. I'll share his firm with yourself afterwards, Steve. But he's involved in the commercial real estate sector. But what they do analytics for that marketplace. So they're collecting data from commercial REIT owners. And I assume with that data, you're able to do lots of wonderful things. And he said, yeah, they're getting ready for the, the mother lode of the recession that's coming. And I said, has it hit yet? He said, no, but we can see it. Like it's going to come. So we are getting closer and closer. And the reason this is important from an investment perspective is that it's what the Bank of Canada, that's what they expect to happen as well. But the longer we don't see it, it would imply that, they will be even more aggressive still, raising rates. So maybe, the next meeting or D7 coming up, maybe they actually do a 50, and sort of which ties in with the American story as well. But central banks right now, they want that recession coming. And if it doesn't come soon, they're still going to raise rates, despite whatever the inflation data is showing. Unlike the Brits, they're just saying outright, we're going to collapse.
The UK have another high
go ahead,
inflation print, Rich?
Yeah, they did. Yeah, I think it was like a 40-year high. I can't remember the exact number, but it was.
So there, you guys are
high.
still printing like new highs.
Yep.
So we're rolling over in North America.
Well, I mean, Canada's, lucky in a way, because it doesn't have the same wage growth that you have in the UK. It doesn't because of the incredible amount of population growth, which depresses labor market to some degree. The UK, there's something called, we can get into the weeds if we want to, but there's something called like long-term sick. And whether or not you believe all these people who are now sick versus not, their wage growth is still pretty high. There's an energy component that's significant in the UK rather than versus Canada. It doesn't really have, even though Canada has had significant pressure on the energy front, it's still nowhere near as what we've seen in Europe and the UK. So there's that kind of stuff. But on the Canada thing, there's loads of negative stuff. I think that the main one that we haven't seen, I think the one that everyone's sort of waiting, and I remind everybody that this indicator, which I'm about to get into, is a lagging indicator, is the labor market. Whether or not you believe those labor market numbers from last month or not, the truth is there hasn't been a wholesale decline in labor market sentiment, or literally the number of people that are getting higher. Especially not in the US and in Canada. And so I think that's the issue. Because if you look at like whether it's, the Bank of Canada business surveys, those are way down. If you look at PMIs, we discussed this last week. I don't want to repeat it all completely, but there's the PMIs, there's the CFI business barometer, that's making new lows. There's the composite leading indicators from the OECD, those are making new lows. The IV PMI, which is from Western, thank you, Keith, and not from out west, from Western, which is in Ontario, which is making new lows again. Indicator after indicator on the sentiment and business side is really not doing well. And the one that's sort of holding up is, in fact, the labor market, and we'll see what happens. So I'm interested to hear some of this anecdotal evidence to see if it corroborates what I'm seeing on the sentiment side and on the indicator side. But it's not good. I mean, banks are tightening their lending standards. Mortgage growth is definitely coming off. Consumer confidence is making new lows. There's something called the misery index, which is the combination of inflation and unemployment. It's something we've never talked about. I can't believe we've never talked about that, but that's making new highs. It's not good. It's not good.
What I mean though is that in Canada, we're not hearing the anecdotal.
Oh,
is that true? Not so much. But in America, Amazon, they just announced they're laying off, I think 10,000. They're going to reduce by
going into the busy holiday season, no doubt.
Yeah, absolutely.
That's the real story. I mean, like we talked about it last week, right? FedEx laying off. When the last time FedEx laid people off, going into the busiest time of the year for them.
And we brought this up a few months back. Remember back then we said, the economic shock coming up is that retailers will have a lot of inventory in the fall because they were ramping up aggressively, and that's exactly where we're going. We always like to say, hey, has anything changed with the path we're moving on to cause us to change our view? And economically, it hasn't. Financial markets are still, doing what they're doing. But, I think the anecdotal stories for America is still quite strong that, we're going to roll over. And that's why when I jump back to the Fed, so last week, Thursday and Friday, it was excluding what happened back in 08, 09, it was the single largest 2-day movement in the US dollar that's been recorded. So over, a very quick 2 to 3 days, like Aussie dollar was up 7%. Same with euro, yen, like it just crushed everything. And, a lot of it was because of positioning, everybody was so long the dollar and short everything else. But it was all triggered by the thought and the concept that the economy is rolling over in the US and the Fed won't have to hike rates anymore. And we keep telling everyone, everyone who's listening, that the Fed will continue to do this until there's a recession. And we haven't seen that yet to happen, but it's coming out. And as well, what people need to appreciate is like every day there's a whole bunch of members of the Fed. Some are voting, some are non-voting. They have set schedules when they're speaking and not speaking and all that. But within the Fed, you have doves and hawks. And the doves are aligned with Janet Yellen over in Treasury. And they're doing everything they can to prevent a recession from happening because they don't want a recession. And whereas the hawks at the Fed are saying, no, we need a recession, to crush this inflation. So that's why you're always going to hear on a regular basis during the week. And depending on what your market view is, you're always going to hear a Fed member say something that you want to hear. So whether it's dovish, for example, like whether you want the equity market to take off and recover and the US dollar come down hard, you're listening for the doves. And if it's the opposite view, you'll hear that the next day. So here we are now here today on what day are we recording?
Bingo Thursday.
Bingo Thursday. Yeah. Today's a pretty good risk off day, but a lot of that now is simply because, markets have recalibrated again. Some of the hawkish, Fed guys have come out and been chatting, but, it continues to be our view that Powell, he wants to hike aggressively and even more aggressively than what people are talking. So opportunities like this, I'd say, hey, it's a gift. If you made some money in equities last couple of weeks, it looks like it could roll off again. If you don't have enough US dollars, hey, as a gift, start buying again. But these whipsaws towards year end are, they're pretty spectacular what's happening. And I think it was Rich, one of you made the political comment, how, the American midterm elections are now over. And, that's going to have a bit of an impact here as well. So I do suspect you're going to start to see less oil coming out of the strategic petroleum reserves, SPR, I think they call it. That should start getting refilled again. Less funny things from Yellen happening, but it could be a bit of a funny year end.
Can I just add something? So, I mean, on the US labor market front, I think it's important, like the FedEx not firing people, and the Amazons and Jeff Bezos coming out and telling people not to buy stuff and all this. I think it's important to just, and then we might see some retail sales data that comes out. It's not as good right before the Christmas period, which Steve, you rightly pointed out as something that's weird. And I would just point out that there's like a goods versus services kind of dynamic that I think we need to just clarify and sort of provide context around. So when you look at retail sales, it's largely goods related. Nearly all of it is goods related. And I think that that's an important consideration when you're thinking about these labor market, sort of all these big layoffs. The companies that have been laying people off are goods related. And the reason I bring that up is because what we forget is actually services make up 61% or 60% of the personal consumption expenditure for the US household. And let's just assume for argument's sake, it's roughly the same for Canada and Europe and most developed nations. And so what does that mean? So in real terms, you've got like 9 trillion US dollars in 2012 dollars that are services and 5.5 trillion in goods. And what we saw over the pandemic, obviously, was it collapsed, and then the goods portion ripped right back up and continued on a trend that was much higher than what we had before, the 2017, 2018 numbers and 2019 numbers. And services, on the other hand, have only just gotten back to trend. And so when we think about what's going to happen over the next 6 months with the labor market, I'm less concerned about the Amazons and the FedExes of the world laying people off and weak, let's say, retail sales than I am with services companies starting to lay people off. And so that's something it's important to people understand. Number one, the differences in magnitude between those two types of expenditures for households, and 2, where the layoffs are coming, and then 3, what to look out for going forward. So, for example, what's a huge services? I don't know, MGM hotels in, let's say, Las Vegas. They start, cutting workers, or maybe, another kind of, I don't know. Services are escaping me, but I mean, because if you look at RevPARs, which is a way that you assess so revenue per booking of a hotel, those are still relatively high. And, if we're looking at whether it's travel, all that stuff is okay. And so it's important that we just distinguish sort of what's happening right now, where we've come from, and then what we should be looking out for going forward with respect to the labor market.
What about like restaurant data?
Yeah, so it's actually okay.
It's still okay. Yeah, because I don't know. Everybody, it's like, I think people always, it's funny, like you always see what you want to see. Right. It's like that confirmation bias.
And I'm guilty of that too, of course. I try not to, but I'm definitely guilty of that.
I know people always go, "Oh, I went into the mall and it was like so busy and like there's no recession." And then like another guy like, "Oh, I walked down this busy street on a Friday night and all the restaurants were half empty." Like recessions, you know what I mean? It's just it's always tough. You definitely need some of the data, but some of the data doesn't always add up either.
No, it doesn't. I mean, something I really we talk about this before, the ISM indicator, with the manufacturing. I mean, it's not all great, right? I mean, we know the new orders for the services have collapsed. We know that employment is below 50. I get it. And obviously the momentum, the direction of travel is absolutely clear. I guess now I'm trying to figure out when it might happen or what to look for to, crystallize our view. I'm not saying it's not happening. I'm saying we shouldn't necessarily over egg the goods part when services is 60% of your consumption basket. And that was really the major point.
There you go. Wouldn't mind, switching gears over to this FTX story continues to evolve. Some crazy stuff there. I was reading today that apparently he issued a $4 billion loan. A personal loan, $3 billion of which went into his hedge fund company, and $1 billion to himself personally. So this guy was just backdooring all these funds. Of course, all this contagion. Once your second largest, crypto exchange goes insolvent, so BlockFi went down. BlockFi was like a crypto wallet. Basically, they would pay you interest on like your token. So you go and you deposit Bitcoin or Ethereum or what have you, and BlockFi would pay you an interest on your deposits. So they were kind of regarded as more of like, they were regarded a little bit more like blue chip. Like if you were going to go and take funds and put them into one of those crypto sort of exchange wallets and earn an interest, like BlockFi was kind of considered like the blue chip. So they're now insolvent. So that they kind of follow in Celsius's footpath, because Celsius was kind of like the bigger, more reckless of the two. And so now they're both gone. So it's pretty crazy. You have like your two largest like crypto lender sort of things, or banks, basically. One of your largest exchange, second largest exchange, now gone. Crazy. Fun story for you. Since Keith's not into crypto here, but
I mean, my only point is we never talk about ESG on this podcast for some reason. I don't know how we've avoided it. We've done 58 odd episodes and we've never really had dove into it. I'm not a huge fan. You can ask me why offline sometime, maybe. I don't think it's not for, my views are not for polite conversation, but I would like to highlight something that I just found really, really funny, which was that there's different types of scores that you can have for ESG, that companies like, I'm not going to give them a plug or throw them under the bus, but let's just say that there was several companies that had leadership and governance scores for FTX that were significantly higher than some major blue chip companies. And it was just, I just thought it was really funny that it was just like like not only was this guy committing an absolute and utter fraud, which I think has set Bitcoin back several years, especially in the eyes of institutional investors, as Keith will attest to. But it's just an absolute, like, it's one thing to blame this kid. It's another thing to just absolve all of these people who are meant to be doing real due diligence on their investments. They flaked it. They didn't do any of the work clearly that you should have done in order to hand all these guys incredible amounts of money. And I just think that's sort of being lost in all of this talk of Bitcoin and fraud. And the reporters didn't do the work. The investors didn't do the work. The companies that judge ESG scores didn't do the work. And I think it's a testament to what we've talked about for a long time, which is what happens when you get free, cheap, easy money, tons of liquidity. You get all kinds of shenanigans. And it just makes you laugh, I guess. I'm sorry for all the people hardworking people lost millions and billions of dollars. That's really
I'm kind of curious though, like what your thoughts, Keith, maybe if you want to chime in here on, like, I think there's definitely some smart people here that got duped. But maybe it goes to show you that you can always, you can appear maybe are known as the smartest person in the room, but even you can make bad investments. Like, what do you, I mean, like Sequoia's got to have some really smart people there. Was it Tiger? I'm drawing a blank. Tiger Management. Like, I mean, there's got to be some smart. There's got to be some smart people here that were ultimately, again, maybe didn't do obviously the proper due diligence, but I think there was an element of fraud. I think there was some deception, and I don't know. It's fascinating to see, again, like people that are maybe lauded as very, very smart people have been caught up in this.
Well, you have to, I mean, first of all, there's a huge distinction between making an investment that doesn't work and then being a victim of fraud. Because fraud, by definition, something's been constructed in a way to deceive you and everyone else out there. And that's clearly what's happening in this case. So, eventually most fraud does get exposed when people, I'm empathetic towards people that lost money with it, because, they got exposed to a fraud, they got tricked, really. But if you make an investment and it turns out to be a bad investment, hindsight is always pretty good with that. Why did you buy this or that? But again, what I'm trying to say here is that people lost money because of this. It's not that they made a stupid decision. all these smart people that were buying it, they were basing on information that they thought was real and accurate. But the other thing, for everyone making investments out there, you're going to make bad investments. Like no one ever. It's like playing baseball. You're going to strike out sometimes, right? It's going to happen. But that's why you make sure you control your risk. You layer your risk in. You only expose with what you're comfortable to having exposed with. Yeah. And I think everyone knows I'm not a crypto guy. I don't understand, I understand very little of it. And, however, we got, maybe we got lucky on this because, we weren't smart enough to jump in and really look into it. But you just have to make sure when you are making investments, and if it's in the crypto world, people say, oh yeah, I'm holding this, they rhyme off 8 or 9 of these different coins, I guess. Again, I don't know what it is.
Coins, protocols, whatever you want to call them.
Yeah, I know I sound very stupid for this, but hey, and I'm trying to be something I'm not. But that's not diversification. Professional, proper diversification. You're in markets and assets that are different from each other. They're exposed to different factors that can move, the price of it and the outlook and everything. People have lost money here, of course. Tom Brady's the famous one, I think. The numbers are pretty high. Did he control his risk? Kevin O'Leary, yeah, he's there as well. And I just hope that people that they have lost money on this, they did control what their exposure is. Because even in the stock market, right? I mean, you make bad decisions. You're going to lose money. And again, if you like, for example, did you buy Enron back in the day? And did you buy because of the story? Back then, it just sounded. It was an incredible story, right? It really was. And it turned out it wasn't an incredible story. It was a fraudulent activity that was taking place, as opposed to being in other markets that they just fell off a cliff for one reason or the other. So I don't know if I add any value with this, but the main takeaway is always understand your risk, what you're getting into, and if you're exposed to fraud, then that's a tough one.
Okay, you're being yes, and I can't disagree with anything, so I won't. But I will say you're kind of glossing over all the boosters. I mean, the people who heard this guy's story about the woke capitalism giving money away for free and just jumped on that without any kind of, I guess it's easy for me to say now because it's all coming out in the wash. I get it, but there was. As with a lot of these things, there were some signs and people who were asking questions. For example, Mark Cajodes is a guy I follow on Twitter. He's been on this for a while. He was insulted. He was blackballed, and he was told to go away because he dared question it. And I think that there's a lot of balls were dropped along the way. So yeah, there was definitely some fraud, but I think there's some people who have some responsibility perpetuating this fraud. And I think that's just, we can't lose sight of that.
You know what, Rich, you're right. You know what, Rich, you are right. I keep saying, hey, keep your elbows up in the corner. You just did it. And I didn't. I stayed out at the blue line. I wouldn't go in there. I agree with Rich, by the way, but
the red flags are that guy's outfits, man. Holy, what a slob that guy is. Scumbag ultimately, but it's
but here's the opportunity though coming up now. We talked last week that that institutional fiduciary money, they will not be touching this space now for a while.
Yeah,
like they're if you're on any kind of an investment committee, I know it's happening this week and last week. The first question is, what is our exposure to it? That's the simple question. And everyone's like, well, we have this and this. And then like the real smart guys are saying, give us the worst number. And for anyone who's listening, if you're ever involved in one of these situations, when, someone is saying, okay, what is the worst case scenario? Give them the worst case number. Don't try to tell them something that you think they want to hear. Because if you tell them, hey, the exposure is, 100, whatever the number you're dealing with, 100 million, for example, and it comes out afterward, no, it's 300 million. I mean, you don't do that, okay? You have to act like an adult. No one's acting like an adult sometimes, but That's happening this week. And once people, they do figure out what their risk is, what the exposure is, I can guarantee you there's going to be a new policy written for the investment guidelines. And they're going to say, it might be written in crayon just so it'll stand out, right? We're not buying this. So from my perspective, the opportunity coming up, because you don't have all this money now going to start chasing in, it's going to be a scramble here, guys, for a while in that whole space. But I like it because I think we are in that space. There has to be lots of incredible good value. Like, it just has to be. The whole thing is not, dog crap or anything. So there's going to be a lot of other guys out there. They're going to be fishing around, and we're going to find stuff. We are going to buy it. We'll allocate to it. I still have numbers in my head when all of a sudden we're interested. And remember back in, was it Vancouver back in May? Remember we did that?
I was just gonna say, was the Vancouver event, was that in May?
Yeah, it was.
Okay.
That was a fun time. That was a lot of fun.
So when we did that podcast, I'll just take you through the chain of events, which is really fascinating. So Vancouver did that event in May. That was basically like the week that like Terra Luna blew up, which is like one of the favorite like altcoins in the space. Everyone was pumping that project, and it blew up spectacularly. So Terra Luna blew up. That led to Contagion, which basically blew up Three Arrows Capital, which was like the crypto hedge fund. Three Arrows Capital, then ultimately, essentially, was what blew up Alameda, which was FTX's hedge fund. So FTX then started draining funds out of FTX into Alameda to sort of support their to try to recover their funds they lost through those blowups. And through all of that, like BlockFi got hit through the Terra Luna, Three Arrows Capital stuff. So FTX actually came in and issued a loan to basically bail out BlockFi. And so, like, it just kind of goes to show you, it's like, what's that old analogy? Like a butterfly flaps its wings like halfway around the world. Like all of this stuff, like everyone's just like, oh, okay, it's contained to like Three Arrows Capital. Or like, we're all good. And like, many, many months down the line, it's like, oh no, actually it wasn't contained. They were just sort of, putting a Band-Aid on their balance sheet. And so we're now starting to see more and more of this contagion. People are saying, well, maybe there's been rumors, again, not validated, but there's been rumors that Genesis is in trouble. That would be, of course, the Winklevoss twins or whatever, responsible for that one. But Binance was out today saying they're no longer accepting deposits of Tether and US dollar coin. Like there's a lot more, I think, that is going to surface over the next 3 to 4 months. So I don't know, take that for what you will. I'm certainly not a crypto expert. I basically only buy Bitcoin and Ethereum. I keep it simple. I now store it in a cold wallet. I didn't actually lose any money on those exchanges, thankfully, but some very, very, very close calls. Let's put it that way.
What else
there
is
she
there?
was. But I remember back at that time when we had the Q&A, and someone asked me then and say, hey, when would you buy this? I think it was at, use of Bitcoin as the proxy. It was at 30,000, I think.
Was it 30? I think it was like anyways, it was like mid 20s to 30s, something like that. Yeah.
Yeah. It's crypto, right? 5 here, 5 there. What's that? What's that between friends? But one of the Q&A saying, what is your target? And I was a lot lower. And finally I said, I felt bad saying it, but I think it was 12 or 14,000. And which I know because we were up on a stage, I saw a lot of eye rolls and some snickers, I guess. But so now we're getting closer to that. And people say, hey, how did you come up with that number? And it ain't hard, guys. When you have any market, it doesn't matter what the market is. When you're flatline and then you have this incredible, very sharp exponential growth and then it's starting to come down, chances are you're going to come back down like to a more reasonable level again. So we're getting there, and I don't know what the number will be in the end. I'm not touching it yet because there's still so much uncertainty that's out there. But we're getting closer, and I know there'll be a bunch of guys, buying this up as well as we get closer to put it this way, when no one else is left to buy, this when other guys are going to come in.
Hey, I
And
think
that's
your
part of
number.
that, like 2.3 trillion in capital out there, right? There's
I
always.
think your number. I think your
Right.
number was 14,000. So we're getting close. I'll come over and help the old boomer figure out how to buy it.
When you see it now, like.
We'll
trying to hit
set
the
up your
keyword.
you'll set up your wallet and everything, and on your
Yeah.
way. Just give me the keys, and I'll save it. I'll store it for you. Rich, what are you thinking? Do you have any comments on this whole? I know you're long Bitcoin, I think.
No, I don't know. I just think when we started this podcast ages ago, I said, whenever you have a new industry, it's important to just be cognizant of the winner. It's very, very difficult to make money in those early stages. And the example I gave was the automobile industry. And, in 1905, there must have been, 24 manufacturers. The car is still around, but very few.
I remember those days.
I mean, the car is still around, but, many, many companies that were the initial pioneers of the automobile are long gone. It's the same with the airline industry. It's the same with the internet industry. Airlines still around, the internet's still around, cars are still around, but those initial pioneers of that technology have long since been bankrupt and have been absorbed by new entrants and et cetera, et cetera. And that was the point that I made in one of our earliest podcasts. I was then absolutely caved in the comment section, and I think that was when I stopped reading the comments. But I stand by that view, which is to say, I think that the technology has clearly showed that there's some value there. Now, we haven't quite figured out what that use case is. I would just be very careful of really ever investing in those initial companies. Those early companies, those early adopters in any new technology, whether it's biomedicine or whether it's the internet or whether it's VR or AI or whatever. In 100 years from now, we'll probably have very powerful, hopefully not overlordy AI. The companies that really pioneered that technology might be gone. And I stand by what I said, last year, and I think it's an important kind of what we've seen the last few weeks is an important reminder of that.
Hey Keith, I got a question for you. So I'm assuming when this FTX they go into bankruptcy, they appoint like a new CEO. I'm assuming it's at the direction of the courts. So the new CEO is the guy who oversaw the liquidation of Enron. Is that just like I'm assuming he's appointed by the courts, correct?
Usually, yeah. Oh, yeah. The company doesn't get to if you go in liquidation.
No, it's just ironic that this guy was basically overseeing Enron at the time.
Yeah, I mean,
right?
because it would have been a good experience on the lad's resume, so to speak. These things are messy, guys. And plus, this is multiple jurisdictions as well. And anyway, it's
so he's quoted here today saying, he says, quote, "I never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information." And he goes on to say, from compromised systems integrity and faulty regulatory oversight abroad to the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals, this situation is unprecedented.
I love the unsophisticated comment.
Crazy.
Well,
so just a couple more names
them.
on that while we're talking about some of the big boys and the apparent, quote unquote, smart money. So BlackRock was an investor as well in FTX. Galloway Capital, Venture Partners, of course, the Ontario's Teachers Pension Plan, which we talked about last week, Sequoia Capital, Skybridge Capital, Tiger Global, and of course, everyone's favorite, Tom Brady.
I think something also it also sort of brings home a point that, which, I've spent most of my career in the institutional investing space. And I think institutional investors walk around like don't stink and they think they're smarter than everybody. And I think what a lot of these kind of frauds and scams and these kinds of things sort of expose and bring light to is I think that a lot of these people think they're a lot smarter than they are. And I think it's there's a lot of group think. There's a lot of like herd mentality, sheep mentality, rather than due diligence. There's a lot of, trying not to be the odd nail that's hanging out. So you don't want to get smacked back in. I think it's a lot of this sort of these biases that we actually I remember learning about this in the CFA, God help me. But it's just stuff that it's funny, and it's rather disappointing, I would say, in a way, because I take pride in being sort of an institutional investor and being in that space, and to see these guys just who are meant to be clever and smart and care about their clients and care about due diligence and et cetera, to have them all to a man. No one really asked the right question. I find it's a bit disappointing.
You're all strutting around in their Patagucci.
That's right.
Speaking of which, if anyone has a connection with Patagonia, some connection, would love a sponsorship from Patagonia, or at least some apparel for the show or for the live event. Patagonia, hit us up.
I think we should put the FTX thing to bed. I think we've
I'm over it.
I'm over it. We've beaten it to death.
I can't look at that. I can't look at that guy's mug anymore.
Yeah, I can't look at his face either. I just
or his
until
body.
Something changes, I think we should move on. There's so many more interesting things to talk about, like the Canadian government raising taxes on beer, which I find outrageous. I mean,
we talked about that. Well, we didn't talk about it on the show, but we were DMing each other there.
Yeah. So that's they're raising taxes on beer, which is, by the way, a regressive tax. So there's progressive taxation, which is the richer you are, the more taxes you pay. And there's something called regressive taxation, which is in effect, the poorer you are, the larger proportion of your income / assets that you pay. This is a regressive tax. So add this to the list of regressive taxes that the Liberal Party is imposing on the Canadian population. Also, it's beer, and I love beer, and taxing beer seems like a crime against humanity. What else is interesting?
This will be the last time the Loonie Hour can supply free beverages at the event.
Right.
So enjoy it while it lasts.
The world hit 8 billion population. That's another interesting thing that happened.
Yeah. On say it again. Oh, on the global population.
Yeah, 8 billion people. That's an interesting thing. I'm trying to anything, but let's not talk about FTX anymore.
Yeah. Okay. Well, I think that's a good spot to wrap it up. Yeah, we'll jump into that a little bit more next week. Live event coming up in 2 weeks. Looking forward to meeting everybody. Obviously, we do have a wait list. If you want to jump on that, feel free. But we haven't really had very many people back out as of yet. But as always, we appreciate your support. Leave us a 5-star review, a comment, a thumbs up, or whatever platform you're on. Share this with a friend or family member. Help us continue to build the Loonie Hour community. I think that's really what makes it so special, as everybody can kind of learn from each other. I mean, we're all here learning. We're just pontificating, trying to bring some value, but it's the community that really makes us special. So as always, like I said, we appreciate the support, and we'll see you next week.